What I'm looking at is just the utilities.
Yeah.
I mean, it's always just all stock rotation again out of big cap tech and it back into healthcare, which looks terrific. Some of the biotech names, they went for energy early, and it's the Dow and the agri names, the nutrient and some of that stuff.
Yeah, Bungie is definitely, but you know what? Those you got to go look at what has been underpriced and has somewhat of a healthy enough dividend to attract. So that seems to be the biggest focus, I think.
Yeah, I mean, in Wisconsin Energy, they have huge wind farms
Yeah,
all over the state, and that's really a nice look in that.
yeah, and even the insurance companies. I'm watching AIG, which was down to under $20, which was lower than it was in 2008. We're right down in there. But I don't know. It's anything that's dependent upon interest earnings. Really, you got to, and the insurance companies are. Besides, whether or not they raise premiums, they're still dependent quite a bit on the earnings. And I guess some people like them because they're seeing the curve steepen. But I think I'm as good in the curves as anybody, and I'm a little nervous here because will the Fed allow these curves to continually steepen? That's a question of major proportion because, again, if everything is front loaded by the Treasury to, let's say, 3 years or less, like the Australians were interesting because in their statement, their policy statement of last week, they talked about keeping 3-year Aussie debt at 25 basis points and lower. So they were basically doing yield curve control from 3 years in. Is that the way the U.S. is going to do it? But if the U.S. does it that way, you can expect to hear from people like Larry Summers, probably, Muhammad Ali, people like that going, hey, you should be crushing the longer end and back, and borrowing for as long as you can because your borrowing needs are going to be so great. So if you can lock in your borrowing costs at over the next 10, 20, 30 years at, less than 1.5%, from the 30 year on down, you'd be doing yourself a favor. That's what we'll hear from certain policy experts as we go forward. So there's a lot to watch here. Again, I'm being very patient with these curves, and and sometimes you want to gnaw on your knuckles because the move has been outstanding. But on the other hand, you had to move up to like 55 basis points and then down to 35 basis points. I'm talking about the 210 because of the discussion about yield curve control. So I'm just being very patient here. We've got the Europeans, which are all over the place. Lagarde was out talking this morning, and I'll tell you this: she's not opposed to a stronger euro because she says it in her speech this morning to the Committee on Economic and Monetary Affairs of the European Parliament, because she talks about that the European Commission's proposal for a revised multi-annual financial framework and we should not forget that the largest supranational issuance in euro ever announced, that is, the pandemic bonds and moving it up to $1.3 trillion, that is associated with the proposal could also have a positive impact on the international role of the euro. That's not to be minimized, by the way, because she sees it for what it is. Now, there is a interesting Ambrose Evans Pritchard piece out last night. Let me see. I gotta find it again. Sorry. Still learning how to navigate this damn thing. Okay. Let me just back up here a minute. Um, the piece was European Union is heading for constitutional crisis. It was the piece he wrote last night. It's interesting. I'm actually in disagreement, but I don't mind to be in disagreement, as much respect I have for him, because he talks about, and he cites plenty of German people who are very concerned about the court and blah, blah, blah. But my response back to Ambrose would be, look, it's gone too big, too fast, and I don't believe you can stop it. So that's all I'm saying. I'll send it to you right now, Chad.
Ira, how do you suppose the economics of the Eurozone would support a stronger euro? I mean, is that possible?
Well, let me ask you another question. Let's flip that question.
No, I'm just
Yeah, no.
wondering, you know.
It's a good question, but as you know, as being the Socratic teacher, let me flip it back on you. So the unemployment situation has not deteriorated nearly as bad as it has in the United States. Now we can discuss as to why, and that's a big part of the policy issue that will be discussed. So yeah, they're both in trouble, I think. You know, I'm not the stock market can have a V recovery. You know, I'm not going to lock up with that because honestly, it doesn't bother me one way or another. I'm just trading it and not locking up with it in any way, shape, or form because, again, I'm watching policy and the reactions you're going to get off of any data points will be fine and tradable, but where's the policy going? But Europe seems to have gotten this under control better, especially if you look at Germany with its policies of paying workers or paying firms to keep workers on. So you've had a less unemployment impact. And regardless of Friday's data point, we got a lot of time here. Well, we have a lot of time, meaning we're going to have to analyze these numbers going forward. And again, you know, it's the same question I asked Santelli, and Santelli brought it to Jim Grant. He went 3 years. I would never have gone that far. My question is December. If you're not sitting here thinking about where's the unemployment number in December, well, you're gonna walk into a minefield of things because it's going to be post-election. Where is the unemployment? Is unemployment 9%? Is there anybody who thinks it's going to be lower than 9% in U.S. unemployment come December? Is it going to be lower than 9%?
I mean, I think it'll be higher than the 3.8 before the pandemic, 9%. Now, who knows? But I think it's going to be structurally higher than where it was before we went into this thing.
Okay, right. And that's why I say 9%, because 9% is viewed as a very optimistic number, by the way.
Yeah, optimistic.
Well, yeah,
no. So what you mean is, you're just saying you're thinking that would be the best case scenario at 9%. Is that? Am I reading you right?
Yeah.
Okay.
And, I mean, look we've just seen, gee, the most intelligent pundits and analysts in the world were only off by 10 million jobs. Yeah, it's not bad. 10 million.
Like Chinese.
Holy.
I know. Let's count almost 5 million people who were furloughed, and ask them, do they think they'll be going back to work? Yes. Okay, great. We'll include them as being employed.
Well,
you know. What's funny is stock market didn't care, and they had the whole weekend to digest that too.
Doesn't care. No, because again, and this is the way I'm proposing. I wrote a response to David on the blog this morning. Look here's the question I posed to you. You're a fund manager. You have 10 million to manage. Okay, I'm making these numbers easy. And you're nervous. You go, well, okay, I've missed this rally. but I have 10 million. So I'm going to buy a 1-year treasury, and I'm going to wait this out to see, because the political change is taking place. What's the tax situation going to look like if Trump loses? And after, I'm going to tell you what, everybody who follows me knows I stay out of politics. But I will say this. His tweets yesterday about General Colin Powell,
That was obscene.
you know what? First of all, you want to call him out for being wrong? He couldn't be more wrong, because he calls him a stiff, which is unbelievable to me. If you read Colin Powell's history and know his history, he'd be about the last person I would ever call a stiff. Number two, he blames it. Well, you thought there were weapons of mass destruction. That is patently false. That's patently false. Colin Powell really didn't believe it. And he said to Bush, Rumsfeld, Cheney, et al., that, hey, you go into Iraq, it's the Pottery Barn syndrome. You break it, you own it. And if there's anybody who had more vision as to where that was going, it was Colin Powell. I found that to be phenomenally offensive. Phenomenally offensive. And I'm looking at it, I'm going, you know what? Why would I have anything? The United States, that was wow. That was beyond the ken. And you know what? Again, I'm a policy person. So when Trump has the right policies, I'll say he's got the right policies, or at least he navigated away from bad policies. They don't always have to be the right policies, but just moving away on certain things. And I'll give him that. But that was reprehensible. That was reprehensible and just patently false. False. And he should have been really taken to the woodshed about that, because and Paul Powell, yes, he's gotten political here because he supported Hillary Clinton in 2016, which I thought was interesting in its own right. But now that's just wrong. And I'm thinking that people are starting, I've been bearish to the dollar. I take no backseat to anybody, not a soul who's involved and out there. Nobody. I've been much more ahead of everybody. Now Goldman, of course, has turned a little bit bearish, and some others, but that doesn't matter. It was why, and it was a policy response. And it'll continue to be a policy response. So I go, why would I be invested until I see some clarity as to what's going to come from these elections? There's no way. There's no way I want my money in the dollar, by the way, because I have a Federal Reserve that is also trying to push the dollar lower. They can't say it, but I just look at the effect of the policy. And the policy says lower, lower. And then I have Lagarde's comments, which I find so interesting. So, I mean, we have a lot of things going on. And listen, I'm also of the belief that the weaker dollar of late for the last 2.5 weeks has helped lift the equity market, by the way, in the short term.
Ira, were you going to say that if there's a change in the White House, that there's the risk of the reversal of corporate tax reform? Is that where you were originally going?
No question about it. No
Yeah,
question
I
about
agree.
it. Because there's going to have to be a movement. Oh, I see a coyote in the bush. It's a beautiful thing, except my dogs. No, I see the coyote. Yeah, interesting. Hold on 1 second. Coyote outside. Where? In the brush, behind the house, just a little bit to the west of the 8th tee. So, yes, I would. If the market is supposed to be predicting, right now it's not. It's just, this is the Fed. The Fed owns this market. The Fed owns this market. And more importantly, they have no exit strategy. Even Lagarde this morning talks about that the ECB at least put a time end on it. And I'll go back to my original blogs, and I was reading them over the weekend from February 2nd on, when I started really covering the COVID crisis, because I just got back from Florida and the birth of my newest grandson. So I had been looking at this, and very intently. And I said, and anybody who wants to go read, the first 0.5%, I took some criticism for it, calling for it, because I said the Fed needs to cut because this is an economic crisis, not a financial crisis. Number two, that when they do this, and especially open the swap lines, put a sunset on it. That's the way I would have set this policy. There would have been a 180-day sunset provision, meaning to the market, hey, understand that if things start to recover quickly, we're pulling back. We're pulling it back and know it so there's no surprises. Unlike, every time they've tried to do whatever we want to call it, the tapering, the quantitative tightening, whatever you want to call it, they couldn't exit because there was no conceived exit strategy. This would have been done with a sunset, that after 180 days, all the programs that we put in place are going to retire unless the economy hasn't bounced back and we have to do our mandate. No such thing. So now, can you imagine what do you think the equity markets would do if Powell at Wednesday meeting said, well, things have progressed far better, faster, so we're pulling back all these policies.
Ouch.
Yeah, we just drop like a stone.
Yeah, I go back.
You know what, Ira? I bet you no sunset provision was intentional, and I was thinking that their intent is to try and let, if they can get it, well, they do have it now, let inflation just run hot. And I'll bet you that's the global central bank thinking right now, is they'll just let everything run hot on purpose, since they couldn't get 2% in the first place for the past 13 years.
I can't agree with that sentiment more. I can't agree with that statement more.
My only concern is if inflation gets out of hand. Okay, stock
what
prices.
Is that? Wait.
Don't.
What does that mean? Out of hand?
Yeah, out of hand. We start running, I don't know, 4 or 5%.
Well, you know what? That was the question that Santelli, after our morning discussion, I didn't know he was having Jim Grant on again, but he asked Grant, if it's 9% unemployment and 6% inflation, does the Fed move? Last night in my blog, I said 9 and 9, so we'll go on the nines. Do you think with 9% unemployment and 9% inflation, the Fed tightens?
9%. No, I think they'll lean on the unemployment mandate and say no.
Well, that's what I went with in the blog, because I think that's absolutely right. And that's why if you listen to the Fed listens, that's what they said. Because it was I'm telling you, George Meany was the only one missing from that Fed listens. It wasn't Zoom, but it was some other video group. They had these people come on and speak. And if you listen to Powell, that's the point of the policy statement. Powell keeps talking about, and I don't have a disagreement with him, by the way. This is not, morally it's the right thing, because he applauded everything that he did, the Powell pivot, January 2019, and all the things that have gone on in the unemployment sector, which is the fact that those who were hardest, who were the first to get, the last to get hired and the first to get fired, were actually doing pretty well. And that's what the Fed was covering themselves with, why they were sustaining the Powell pivot, because they had heard overwhelmingly, especially from Hispanics and blacks, that the job market had been the best in 50 years, 40 years, whatever number. So he has to go and protect that, because that's the only rationale for sustaining whatever policies they've sustained. It's that. So if it's 9% unemployment, who do you think is going to be unemployed? Therefore, the Fed has put themselves into a trap. Or as Peter Bookvar continued, and I'm doing a Bookvar podcast tomorrow, by the way, at the Financial Repression Authority.
Oh, perfect.
Yep, it'll be good.
Yeah. Now, Ira, the one thing that this is probably a little bit more intermediate term, since we're talking about the inflation. We're going to have to probably wait and see what the stock market reaction to inflation is, because stock prices did not like inflation in the 70s, but basically corporations have not really been able to get any traction with pricing power over these past 12 years. So maybe stock prices will love it because they'll get some pricing power. That's what's in the back of my mind, but I have no idea what's going to happen this time around.
No, we don't. We don't have an idea because, it can be the Zimbabwe effect. Now, that doesn't mean we have that kind of, I'm not saying that kind of inflation. But when there's inflation and interest rates are so low, people gravitate to buying assets. So instead of buying pictures, you basically pull off what the Swiss bank is doing and you buy equities, because at least I'm getting some yield. And the equity market may initially like it, because don't forget the impact of low interest rates with a higher inflation, which creates great negative real yields, results in the easing of stress from debt, okay? Because it's what Irving Fisher and others refer to as the monetary illusion. Because I'm paying back debt that I took on with inflated currency, which is why even Rogoff, and this time it's different, suggests that inflation stay at 6% for a few years in order to ease the burden of debt. That's why you do that. That's why when governments after wars, it's all hyped up and the inflation eases some of the restrictions and stress from the vast amount of debt that has to be paid back.
Yeah. And God help the unemployed and the underemployed and the middle class under those circumstances when they go to the grocery store. They're already seeing it. I mean, I have people commenting to me almost every day about grocery prices.
Oh, it's
Angela, that's right. But that's why I have spent years, and long before I was writing a blog, poking at the Phillips curve. Again, because the Phillips curve, when they all go back and look at it, it's when private sector unions, now I'm not saying public sector, private sector unions had a lot of power. So you had the discussion about demand pull, cost push, because unions had enough power to push for pay raises. So you had the wage price spiral, okay? If you want to see why the American middle class has gotten crushed over the last 40 years, and I mean crushed relative to the top 10%, it's because they didn't have any wage negotiating power. So their wages have until recently been very stagnant. Because
I mean, it seems to me, Ira, that the Phillips curve probably was useful pre-globalization, right? And then once we got once China got into the WTO and we got globalization, full steam ahead, the Phillips curve in no way could take into account, nor did they, or Janet Yellen or any of them, take into account the global labor pool.
That's right. And that's my final criticism of it, because it's a domestic based model. You know what? As soon as 1989, the wall comes down in Berlin, China is on the move, India is changing, Russia is, you unleashed a massive amount of workers on the world, and you without capital controls, and you allowed capital to run around the world, basically arbitraging wages. That's what's been done. You want to see the hollowing out effect of industry middle class? That was it. Capital reigned and labor was subservient. Now is the pendulum swinging? I don't know. We have to go back to Thomas Piketty when he talks about, growth and inequality, and as he, boils it down to one line, which is R was greater than G, which is the rate of return on capital was greater than growth. So therefore, capitalists have been far more rewarded, Wall Street far more rewarded than has labor, labor has suffered as jobs were moved to China in search. You had NAFTA. NAFTA didn't come about on a whim. They knew exactly what they were doing and what the change was. And the Chinese depreciation of the yuan on January 1st, 1994 was no coincidence. These are not coincidences. These are not coincidences. These were all response to the effects of what they saw. And the ability, the serendipitous nature of capital around the globe, which you wound up seeing, its effects in 97, 98, after the Chinese devalued. And then you had the Asian tigers who had borrowed and had built up all this industrial capacity, who got waylaid by China's depreciation, and you wound up in crisis. And had they actually put on some type of capital controls, the crisis would have been far less impactful. Because why do I say that? Because Mahathir Mohamad in Malaysia did exactly that. And then Brazil actually embarked upon that with a 3-year, if you sent money into Brazil, I think it was, I'm pretty sure Brazil, 3 years it had to stay. Otherwise, it was like owning a CD that you had to cash in early. There was a penalty. So, so labor has really suffered over the last 30 years because of the change in the nature of the global economy. So Angela, your point is very, very well taken. And that's where we reside. Now, how do you respond to it? Because now we're at a new point. We're at a new point. And again, I'm giving you the Fed's word. These aren't my words. Just follow the Fed. And I think.
Are you of the opinion? Are you, to take it full circle? Are you of the opinion that we haven't finished the labor and credit cycle yet?
Oh no, not in any way, shape, or form.
Yeah. Yeah.
Not in any way, shape, or form. I mean, it's still playing out. And you know what? And the election of Trump was an absolute answer to that. Because really, Hillary and the more Democratic moderates were deemed to be, in Wall Street's pocket. And they were. Nothing says it more. Watch the Obama administration the first 4 years with Tim Geithner, who I can't stand, who I think did more harm to Main Street than anybody. And he would really openly admit to it because he believed that Wall Street and the banks were much more important. Yeah, they were, because you placed that burden upon all of us. So it was my problem with Obama, is that he went with the Democrats, what I call the Bob Rubin wing, and the way that the policies that they put in place. And he was really way too naive. Listen, Larry Summers is another one, highly responsible for it. Highly responsible. And Main Street paid the price. It was easier to foreclose and crush homebuyers, or those. Yeah, okay, you can argue like the Tea Party and take a moral stance, but the bigger moral stance is, why did Wall Street lend to them, and why didn't you let them go down? We can spend that morality tale chasing it round and round and round. But the policies in response to it really should have helped Main Street more, but you didn't. So they continue to be plagued by the favoring of capital over labor. And there was a price to be paid. And we got Donald Trump for that reason.
So far, not much has changed.
No. Well, Trump has had good optics. When we look under the cover of it, not much, but he's raised the tariff issue. He's gone after China, which has been the greatest recipient of the free flow of capital around the world. Nobody put themselves in a better position to take advantage of it than the Chinese. So he's made them the target. And if you listen to, um, what's his name? The guy we talked about the other day, Trump's Jiminy Cricket.
Navarro?
Kudlow? Kudlow?
No. Bannon.
Bannon.
Yeah.
Oh,
And what does he say? The election will be China, China, China. That'll be the theme, because it sells. He's standing up. He's standing up for the Rust Belt. He's standing up for jobs come back, because again, capital rush there. Now, American corporations were rewarded, highly rewarded, and investors were highly rewarded for moving jobs.
And now he's punched him in the nose and he's got nothing for it.
Well, you know what? But he still gets good optics,
Yeah.
whether we like it or not. And he knows how to fire off, you know what? But, and the Democrats, they don't have an answer.
None.
None. That's the biggest part of it. Let's not look at the Republicans and Trump. What's the Democratic answer? They don't have one. They go off on tangents. They go off looking for things that make them feel good. This is no time to feel good. This is a time you need real policy. And Biden fails because he's an old line. You guys are too young, but I'm old enough. Because he's the type of good Democrats that I was always comfortable with. The Humphreys, the Frank Churches, Henry Jackson. Those were, because they were blue collar oriented. They had the support of the unions, and they fought, for private sector workers and jobs. But he joined listen, and I can't fault it. I can't fault the Clinton group, meaning Bill and Bob Rubin, because they did yeoman's work, because the walls had come down, labor was free around the world, and capital flowed, and they answered to that. But again, how much of something is too much? Or as Herb Stein famously said, it can continue until it possibly can't go on anymore. How long can it continue? Still, it can't go on anymore. So listen, capital has been rewarded. There's no question about it. And it was due to the change in the world. And once all these workers were unleashed and they needed jobs, and you had governments, quasi-mercantilists like China, not quasi, fully mercantilist, they were mercantilists with a communist face. They were powerful entities. But now, again, the pendulum always swings. So it swings one way, it's swinging the other way. How does it play out? Don't know. I don't know. But I look to the Fed, because the Fed is driving this rally. You can pretend. Don't tell me about V recoveries. This is all the Fed. And the fact that money is so friggin' cheap, they don't even have to add money. Everybody's talking about, well, they're not, they're jawboning it, which is good. And they're not having to put anything really in. They can just keep pushing, and jawboning when they see it go the other way. Although the yield curves are going to be interesting. This will be the last part of this segment. Typically steepening your yield curves in their early facet, and this answers your question, Angelo, actually are supportive of equity markets. Because
has the Fed's balance sheet, I can't tell, and I have to go look, but as far as you know, has the Fed's balance sheet matched Treasury issuance thus far, from all the stimulus?
More.
Okay. So we've got net additions to liquidity, it's not a net negative.
No, and when they're doing on the short end is they're bailing out the dealers, because the dealers will take the Treasury bills that the Treasury offers. And because the Fed doesn't buy them in the primary market yet, but from the secondary. So when the dealers take them, then they just, it's a nice little arbitrage they have going on. Yep. We'd all like to be dealers right now.
Oh my God. Talk about money printing.
I could live on 5 pips on $1 trillion. I could.
We, everybody listening to this, we could probably share it and everyone would still be well off.
I think, yeah, I think we'd be okay. I could even afford toilet paper. So yeah, so that's where we sit. So the yield curves, and they really do get interesting here. And it will be, the Fed has to be very attentive here. Because where's the 210 today is over 60, I believe.
Yeah, I think it's 62.
Yeah.
Last I checked earlier
again,
this morning.
And again, I take no backseat to anybody because I said stay as short as you can. Because nobody's talking about the people who are getting hurt in the bond market right now. Judd, take apart TLT only because it's where most of the idiots will go. Oh, I'm buying. What's been the range over the last 2 months in TLT? I don't have my screen up.
Hold on. It's been pretty big. I mean, the low was 139 March 16th. That high when the bonds went up to 187 was 179.10.
And where are we today?
And we're at 156, so basically almost halfway, right in the middle of the range.
Yeah, so everybody went to hide out there because the deflationist argument, which was, and there were some people I have great respect for making that argument, but I don't see it. I don't see it because the Fed has showed me what extremes they will go to. That's why I was getting bearish the dollar. When people are going, I still think that when they show you that, why would I hold an asset that they're telling me they want to crush?
Well, as long as you're talking about the dollar, what do you make of that yen move today? I mean, I didn't even notice it until I realized yen's all the way back to the 200 day. And dollar yen, and is that all bringing money home to buy Japanese stocks?
No.
Okay.
No. I mean, you could be right in that, but that fascinated me from the get-go today because I said, is this the leg that shows me that the dollar is getting ready for the woodshed? Because last week, and the weakness in the yen was due to the unwind of euro yen, even Swiss yen. And now, Judd, this is like when we were young, when the dollar would go down across the board. We haven't seen that in quite a while. But if the yen were to actually start going up here without the euro breaking, and maybe even rallying, because as I said, I think that 200-week moving average in the euro is going to become a very important pivot. And that's why I'm glad it failed there on, when was that, on Thursday, Friday? Yeah.
Yeah.
I was glad to see it fail there because I like when it fails at mean reversion numbers of significance. So I was glad to see it fail there. In fact, I actually got long on the severe break. I had been out, so I used it on Friday because following upon Lagarde and Lagarde's speech this morning. But I think that's a big tell, and it's not for Japanese bringing money home because there's no return. But if you look at the JGB chart, not for Peter Bookvar actually in his piece this morning brings it up. If you look at the 40-year JGBs, again, because the BOJ is not buying them, people are hitting them pretty hard. And that curve is starting to steepen. So I find this all, even Japanese 10-years are, basically, you'll get, don't anybody get too excited, is at 5 basis points.
What's a symbol on that? Or is it you looking at a cash chart?
No, I actually look at the futures. ZTU0.
And what's a month? SEP?
Yeah, that's the SEP. That's why you.
Huh.
Ira, do you think there's any chance that the Fed could lose control of interest rates and then be forced to enact some sort of yield curve control?
Tell me what, I don't understand what lose control.
Well,
Donna Summers?
let's say the 10-year, ramps to 3.25, which is where it
Oh,
started to.
not a chance in the world, because you know what? Think about what will happen to the mortgage market. That yield curve then would be out to, I would make it at 300 basis point. I would love to see that kind of move, to tell you the truth, as a trader. And the equity market would probably like it too, but I'll tell you what, if that's the case, gold will make all-time highs by a lot. Yeah, because again, and I noted in the blog, for all, all the pundits on CNBC, and I'm taking CNBC to task because I don't listen to them anymore because it gets ridiculous. But last week, with the 10-year moving, what did it move, 20 basis points higher for the week? 22 basis points higher?
Yeah.
Where was the dollar rally? The dollar's supposed to rally. That's all I've heard. They'll come on and go, so the dollar's higher that day. But the dollar had a miserable week, and the 10-year rallied 22 basis points in yield. So, okay, so you'll come back and say, well, the Bund, yeah, but the Bund is still negative 35 basis points.
I mean, at 3.25, the economy would choke.
Well, but I'm going to tell you what, the corollary question to that, if for some reason people just started selling, because that's what it would take, and I don't believe it can happen in this environment, but let's say it did happen. It's a theoretical. So and it's not even a New York Times straw man theoretical. This is a real theory that you're asking. So let's say it went there. Where do you think the dollar index is?
If they continue with all of this issuance and new stimulus programs, I would guess, my best guess would be lower.
I'll tell you what, and you can mark this down and hold me to it. And I don't give forecasts because I think it's such a fool's game. It's like guessing the unemployment number. I'll put out the consensus, but I don't make it. It's such a fool's game, and nothing says it more than the fact that they were off by 10 million. So, was I less off? It's like fund managers who patted themselves on the back that they only lost 40% in 2008 rather than 45% like the indexes did. Okay, yeah, good one on you. I'm willing to say that if everything right now that you saw and it was the same, meaning overnight interest rates were 0 to 25 basis points, and the 10-year was at 3.25, I'd be willing to guess that gold is about 2,300 and maybe higher, and the dollar is at 85 or lower.
Oh, that's all right. So I like that theoretical. That's a new spin. Overnight rates at 0 to 25 bips, and the 10-year at 3.25. Holy moly!
Yeah, right. Let's play with that, because that'll stand people on their head. But that would take us back to when Judd and I could actually make money in the pit.
Yeah,
Meaning,
it's a really interesting level on the. That's a big 10-year swing coming back in the dollar index.
Well, that would be the market doing it. Don't forget, and that's how people forget that when Volcker squeezed inflation out of the system, that yield curve inverted, I believe, to about 600 or 700 basis points. Inverted.
I'm going on my walk.
Okay.
So that's a lot to chew on, but I'm good because my my Jiminy Cricket, who sits on my shoulder and reads my stuff and corrects me, and will raise some questions, is going on maternity. So we are going to do more electronic. So Judd,
Yes.
do with it as you may, because I'm going to be showing up somewhere, hopefully four days a week, to discuss exactly like this and lay out some theoreticals. But in those laying out the theoreticals at any time, we'll come back to the reality of finding good trades.
Okay.
Okay, so
I mean, Ira, wherever you want to go or whatever you want to do, I mean, I'm in. So.
okay, all right. So I maybe do two here, but we'll let people know. And it's like Bosco say, he'll try it for, so we'll have a start date. Right now, I don't have a start date because I don't want them just, to be, oh, we're starting now and then nothing's going on. So, oh, now it's either, pay or just, get out of here. So, and I don't know how many people we can take up to on these Zoom conferences. Do you know?
Well, 500 in here.
Okay. All right. Perfect. Perfect. And as long as we have it scheduled, which it really gives you, and I keep explaining this to people, this gets you almost into like a hedge fund type daily conference, because the best hedge fund, that's what they do. They sit for X amount of time. I only hope to do these for a half an hour unless something really is burning. And the questions ahead of time would be not to me, but you should have them lined up, Judge. I don't want to see them because then I get too, it's like when media people outside of Santelli, when they have me on and interview me, I'm talking about people on television and radio, they want me to give them something ahead of time. Well, I don't want to do that because that pins me into a very parochial view. No, and that minimizes where you people want to go. So I don't want to see them.
Okay, and the other thing is think about the time. You want to do them between 7:30 and 8:30 before New York comes up?
Yeah, it's a good question. Now I'm still here in Arizona, though that won't be for much longer. So, for 7:30 is 5:30 for me, and
Yeah,
I'm up
okay
at
with
4.
me.
I'm up at 4:30. So kind of do a poll and see if people want it early or they would rather do it after Europe closes. But I think I will always think early. That's why I blog in the afternoon and evening, because I like to get out ahead of the market. I really started doing it that way because people who I respected, like Gartman and others, I didn't want anybody ever to say that I was stealing their stuff. So I always tried to get it out the night before.
Okay.
Because I would never.
It would seem to me, Ira, whatever it is, I think there would need to be consistency so that everyone can block
Agreed.
out their calendar, at that appropriate date and time, that sort of thing, so that there's reliability.
Yeah, that's 100. I couldn't agree more. That's what we're striving for.
Oh, you know what, Ira? And to go back to your comment about gold before, so last week the MOVE index rallied 20%, and the gold VIX didn't budge.
Amazing, right?
Yeah, I mean, look, gold corrected, but the gold VIX didn't budge, which is what I was watching.
Yeah, that is fascinating. Fascinating. But I'll tell you what, and the gold is interesting because again, I go back to that podcast and it's I think one of the better one. Not, but I can't say that. February 2013, when I was on Watchdog USA with Greg Hunter, and I made that comment that gold was a tired bull and it was time to get out of 50% of your gold and go into stocks because that was before the taper tantrum, of course, but the Fed had proved that it wasn't going anywhere, but it also showed that they had weathered the storm and the equity markets were much better priced. If you accepted that argument, it was much better priced than gold. Gold to the S&Ps here is very important, I think. Very important. because if we don't get any more of that correction, I think we talked last week about that 1650 to 1675 area as being pretty important.
Yeah.
So we got a good test of that, and we like tests. Listen, if you're in the market at the time and you're trading, it's not easy to absorb, but we like tests because that's what markets need to do to show you whether there's validity. So if the gold starts up here, even with the equity markets, this will make this different, which means that the gold, Angela, can push higher. Because again, what currency do you possibly like? And why do you like it? The emerging markets have done very well. Judd, as you've been very nice to say, on what I had the ruble laid out and the peso, we've had the Brazilian real I watched, but it was up to 5.9. Now we're at 4 point. Hold on.
It's 4892.
We're at 4.89. Yeah. So, we've seen some very interesting moves here. And again, tell me what you want to own and why you want to own it. I know why people are buying stocks. There truly is no alternative. And unless you want to buy 10 years, but again, why should I buy 10 years yielding 90 basis points if I think the Fed is successful? Everybody who applauds, and look at the Fed provided the liquidity to stem the threat of the solvency crisis, at least for the moment. But if you think that they're successful, the last thing I'd be doing is buying anything of duration as far as fixed income. Unless, you're going to go out on a limb and you bought Delta bonds or American Airline bonds. And yes, you're doing well. And the Fed actually helped you there immensely when they announced that they were going to be buying bond ETFs. And now we don't even know, now they talk a lot. But this yield curve, this YCC, as we'll call it, yield curve control, is going to get interesting. How high will they let these yields go on the long end before they try to tap them down?
So with that in mind, then it seems to me that we really need to pay keen attention to the direction of real yields. Whether they're expanding to the negative side or expanding to the positive side. That's going to.
Well, Angela, tell me, what's the real yield on a U.S. Treasury right now?
It's let's see. It's got to be negative.
Unless you think that inflation is at zero.
No.
Okay.
I don't think it is.
So
if we say it's at 2.
Yeah.
Right, and we got the 10-year at 90 bips. Let's just round it up to 90 bips.
Yeah.
There's your negative real yield.
Yeah. Oh yeah, by a lot.
By a lot. And does that ratio expand, let's say, or contract? That's that'll be the other thing.
Yeah. No, that's right. And an interesting area to watch now too is the muni bonds, because with the Fed. Because the Fed's going to pump massive amounts of money into state, county, and local areas whose tax revenues are going to be absolutely terrible, and in an effort to keep borrowings low, are going to be purchasing all that municipal debt. Look at the Illinois is the first to come. If I was Illinois, I'd be pushing 50 billion onto the Fed books. Here you go, boys.
Well,
Ira, do you have an opinion on tips?
No, I'm really not good. I'm not good enough with them. I should be, but I always look to other things because, you know what? I never got involved with tips because of the way they set every 6 months. Or that's how they used to. So I should be, I really should do a little bit of work on that, but I find other ways of comfort that I can play that via yield curves. I'm fairly
Gotcha.
creative in the interest
Right
rate
on the
world.
200 day, Angelo. What do you want to do with them?
So, I mean, we've covered a lot of ground, but again, I'm interested in policy. You know, I brought up the Colin Powell issue because I have such great respect for Colin Powell, and that was one where the information was just wrong. But that was not a political statement. That was, hey, I'm calling you out because it's just wrong. And if you read my blog and you see how I end it, now I was actually reading the book over the weekend, Saturday. Took me 2 hours. William O. Douglas, Points of Rebellion. Now, William O. Douglas was a Supreme Court justice, one of my favorites. Way too liberal for a lot of people, but he's a great free thinker and wasn't afraid to say what he thought, which I liked. And when you really read his stuff, he's very measured, and he had practiced as an attorney besides being a judge in his life, and had a lot of experience. He pulls that quote out that I use. It's on page 58 of the Vantage edition of Points of Rebellion. But I had that poster. In fact, the quote is longer than the one he uses. I had that poster on the wall in my bedroom for 10 years. So it's a very meaningful quote to me because it says a lot. And I hadn't read Points of Rebellion. I've read it many times, but I have not picked it up in years and years and years. But I thought it was time after all this going on to go back to it. And you should read it. It's 98 pages long, really worth a read. And the pages are half pages, so it's probably really about 50 pages by any ordinary standards. And he writes beautifully. So very interesting times. And the only reason I care about that is because it's going to tie the Fed's hands. The Fed has tied its own hands, as Bookvar nicely talks about in his piece, that forward guidance is worthless because all it does is put the Fed into a bad situation that they can't remove themselves from. And I'm all about the exiting. These policies are significant, but you have to present me with an exit strategy.
Well, I'm looking at your gold SPOs, and I went to the pit session. You know, so we go all the way back, and we're right at we went up to the 200 day on Friday, and we rejected it again today.
Well, and I'm only looking at Judd relative to that situation I talked about going back. You know what I mean?
Yeah.
That's the only reason, because that gives me, you know, it's like looking at the S&P bonds over a long horizon. You get perspective. You get perspective. And we need to look at this through perspective because, you know, honestly, I sold, very honestly, on February 14th, 15th, I had liquidated my entire retirement, my SEP account. And I felt bad sitting in way too much stock because I still had, through other venues, stock. But I look at this, I'm not buying, all I'm buying, as I've told you, is ag and mining and high quality companies with low debt and dividend payments. So I'm looking at, Verizon and AT&T utilities.
Right.
And some bank, I've put over the last 2 months, I've been buying UBS stock. I won't buy any now, although it looks kind of nice because it jumped the 200 day. So we'll see.
Ira, what do you think about some of the specialty chemical companies?
They're probably
RPM, the PPGs, the RPMs, maybe Dow, DuPont.
It all depends what they look like on a longer term horizon, and I haven't watched them and what their debts. I'm only buying companies with low debt, and I don't want companies who are taking on massive. After refinancing, if they're high quality companies refinancing whatever they can at this time, fine. But I don't want them taking on more debt. For what reason? For what reason?
Yeah.
I
remember a couple of years ago. We were having a discussion about the Fed's exit strategy,
Yep.
You know, and every time they try, what happens? We get, you know, we get some sort of shudder.
Right, right. And that's where they failed because they fear markets, but they don't respect markets.
And you know, I went back and I was looking at, so I looked at the first quarter of 18, right? That was a 10% correction in the S&Ps. The global markets kept going down, but that was a 10% correction.
Right.
Then we got the fourth quarter of 18. That was a 20% correction in the S&Ps. This time, in March, we got a 30% correction, and I'm finding it really interesting, 10, 20, 30. And I'm thinking to myself, oh my God, what if this pattern continues?
Yeah. Yeah. What if this pattern? That's right. Because every time, and I go back to June of 2013 or May, the taper tantrum. And when Bernanke walked that back so fast, I said, they can't exit. They're really, and then they did little bits and pieces. And then when the market would reach a point where they challenged them, they caved every time. Nothing.
Well, Janet Yellen's first rate increase in December of 15.
Right.
Boy, did that upset the apple cart.
Right. And you're right. And then she slowed that down. I gave her credit. She was at least willing to go that route. And then, Powell's error, Druckenmiller cited it. But Santelli and I talked about it months before Druckenmiller. I didn't say it's a double shotgun, but I said, I do one or the other. Do one or the other. Either raise interest rates or shrink the balance sheet. If I ran the Fed, and I wrote a blog piece months before that if I ran the Fed, I'd be shrinking the balance sheet first and seeing how that went down. And you know what? It's in writing. So I don't have to hide from it because there's no thought to it. They just proceed, and those are the errors. The errors are not in what they do to face a crisis. The errors are in the fact that they don't know what to do to exit that crisis strategy. And that's significantly important. It's like going into Vietnam. I know how to get in. I don't know how to get out.
The Bronx Tale.
Well, but more importantly, one of the great things I learned as being a trader, my exit strategy is in place as I'm going into battle. I know exactly where I'm getting out. I never, ever go into a trade without a sense of how to exit and what will prompt that exit. Now you can say, well, you can't just move troops, do you know what the logistical? Okay, well, maybe if you thought about that, we'd have less wars anyway, which is never a bad thing.
I like that.
It's one of my big issues with the MMT crowd because I can finance wars to my heart's content. As long as you let me run the printing press, I could do whatever. Guns and butter, baby. Guns and butter.
If social programs are so wonderful and work so well, why don't they just give everybody $1 million salary? Forget a $15 an hour wage, okay? Just how about we pay everybody, okay, 150, 200, 250. If it doesn't matter, then it shouldn't matter how much we pay everybody.
You pay them $1 million and they still won't get your order right at McDonald's. This is my biggest problem with that whole wage rubbish.
Yeah.
I mean, I've always believed that, what you get paid should be relative to the value a person brings to the table. I mean, when I was in high school, I got paid minimum wage. Why? Because I was in high school, right? And it was my first job working at my next door neighbor's pharmacy, counting Valium pills and Librium.
Is it, well,
Hey, I delivered those at a pharmacy. I had millions of jobs. You know what? My parents,
You know,
they taught me.
I mean, back then I got paid $2.20. What is it? $2.25 an hour? I think was minimum wage.
no, I got paid $60 a week from Barry. That was total slave labor.
Yeah, and when Lenny was paying me 200 a week in 1977, and I was already running the arbitrage, 200 a week. And every week he'd pay me, he'd go, God, you're overpaid.
Oh, God.
God.
He said, you don't know anything. I'm teaching you everything. You should be paying me. He said, but I know you got to eat. So here's your check. Here's your check, $200. Thank you. True. And he had me convinced that I was overpaid. That's how good he was. But this is really the last thing I'm going to say, because I'm thinking about it as we talk. And this is one of the great things about doing this. Does the lack of a Fed exit strategy mean that they really have no confidence in the effective outcome of their policies?
But yeah, and that's something to ponder.
And yeah, and if you think that, then you think about all the possibilities that exist.
Ira, I'll take that a step further.
Okay.
And I will say that the political elite, the wealthy, all right, are fearful of losing their position, their wealth, all of it, in the event that we were to undergo a good old-fashioned recession. So to me, it's to quote the Bible, man injuring man to his detriment. The powers that be want to stay there. And the only way they can stay there for now is to continue this game that we're trying to figure out how does it end.
Well, how do they keep their power if they're going to dismantle all the police departments?
Well,
What is that?
that's a new dynamic.
Yeah.
Yeah, that's a whole different discussion. That's a good point. There's a lot, but you know what? Again, I'm not interested in the politics of that because we could sit here all day and on. But from the financial perspective, how we deal with a Fed that really doesn't believe it's going to be successful in the policy implementations that it goes through is a very important question because it'll determine how we look at the investment horizon going forward.
Well, that's why I brought up the depth of the recent earthquakes going from 10 to 20 to 30.
Yeah, no, that's right.
Well,
There's a lot of things here, and you know what? Again, because everything the Fed has done has broken the signaling mechanisms of capitalism, it's very hard. That's what makes it so difficult. That's why Druckenmiller, this morning says that, he's, what was the word he used? He was...
He played it way too, he was way too cautious, he said.
Yeah. And, and of course, they won't bring gun launch out until bond yields fall and the stock market is cratering again. It is unbelievable. And then people give it, then I'm going to get 50 emails. Did you see Gunla? I said, well, he's been bearish, as was Druckenmiller. But Stan, will stand up why, I really had this.
I mean, Gunlock was bullish on rates, meaning lower bond prices.
Yeah, that's right. And because it was, the stock market was, going down to levels we weren't going to believe. What else? There's a multitude of, and that doesn't take away that he's a smart guy and a very astute investor. Not at all. But I'm not poking at him. I'm poking at the media because they got to roll it. It's like Wall Street always presenting a bull and a bear. Depending upon what you want to hear, they got everybody lined up. It's just a show game anyway. So that's that's really it. And we just care about where this is going to take the policy. And these yield curves and the dollar, pay attention here.
All right. Well, thanks, Ira.
Okey doke.
Okay, all right, and we're gonna work, so Judd, collect all kinds of recommendations as to the people, kind of poll these people, and I'm gonna probably put a blog out, that'll be my last one for a while, tomorrow, and I'll get a sense of,
Yeah, and then you got to figure out how you want to, do
Yeah.
it. I think you should
Yeah.
run your own.
you know what, I don't know that I wanna do that, so,
Well, whatever you want to do. All I need is a list, and I can invite everybody in. So that's,
yeah, well,
that's easy.
yeah. As long as we can go up to 500 people, and it's a set time, I think that works pretty well.
Okay.
Okay,
All
all
right.
right.
Great.
Sounds like a plan.
Right.
See ya.
Bye.
All right.